So Corey, now that we're becoming the crypto kids,
Boy, that escalated quickly.
Corey, now I don't think we're going to be reviewing the cash and carry trade so quickly. Just a few weeks have passed, but obviously a lot's going on in the crypto markets. So the big question of the day is, did you manage to blow up the trade, even though it was a market neutral trade, but there's a lot of liquidations issues when we're talking about crypto?
Man, I don't think we could have top ticked the market better in calling ourselves the crypto kids, my friend.
My fault.
Look, yeah, we're not gonna walk through the exact cash and carry trade again. If people want to watch that, I really suggest they go back 2 weeks, watch the video. We'll link it here, however this works on YouTube. But I think the important point, the risk we pointed out in that trade was counterparty risk, was the real big risk. Even though we were hedged to movements in the underlying cryptocurrencies, there was the risk that either your counterparties on the exchange couldn't pay you, there was some sort of exchange issue, or some sort of auto-liquidation issue. And the idea of the auto-liquidation issue being that you need a counterparty on the other side of your futures or perpetuals leg of the trade. And if all of those parties, all those longs who are opposite your short get wiped out, and no one steps in to take it, your short can get closed on you. And so the big question is, during a huge crypto market crash, is your trade going to stay whole? Are you going to stay hedged? And that was the big question when I woke up yesterday morning, seeing that the market had violently plunged overnight. Jason, crypto markets are prone to strong pullbacks. I mean, you've got a highly volatile asset, annualized volatility in many of these cryptocurrencies well north of 70 to 100% annualized. To see a 30% drawdown is expected. It's certainly not unreasonable. Do you think there was a catalyst to this drawdown, though?
I mean, everybody's pointing out, the Elon tweets, right? And as you and I have been in traditional finance markets for such a long time, we always see that traditional finance news always comes out with the catalyst or the causality and the links. But as we know, it's never quite that simple. It's just an easy finger to point to is the Elon tweets. What I thought is interesting is, like you said, if you have a 70 vol instrument, you're going to experience volatility, right? Especially if we're at margin usage is at an all-time high, expressed maybe by open interest is how we get a gauge of where that's at. But I think part of it too is that liquidation phase, right? It's basically, as we know, everybody's got taken out. Once the market dropped to about 38,000, all of a sudden you saw it plummet down to 32 quickly because we had all of these margin loans, and this is where people's stop losses were, and those just got auto liquidated.
I actually, somewhat ironically, ended up publishing a podcast with David Fauchier this week from Nickel Digital, and it was all about crypto markets. Timing totally unintentional. But when I first started chatting with him, he was discussing this idea of what they called liquidation cascades.
So the largest derivatives exchange till recently was called BitMEX, and they listed inverse perpetuals only. So you margined in Bitcoin and got US dollar Bitcoin exposure, or you margined in Bitcoin and got ETH USD exposure. So that's a quantum. And that kind of inverse product has interesting microstructure characteristics and features, because especially if you think about it on the way down, if you have a collapse in price, the value of your contract is going to drop. And at the same time, the value of the collateral you've placed against it is also going to drop. So you have this kind of super linear relationship where you can get these huge crashes because you need to suddenly be putting more collateral on than if you were margining with something stable like a dollar.
But the key point he was making was that when you look at crypto exchanges, you have huge fragmentation. You don't have any cross-clearing capabilities with the exchanges. Moving collateral can be very slow because you're operating on block time, and you have a lot of participants that are highly levered. And so all of that works in a way against stability in the system once you start to see prices sell off, because it leads to very violent unwinds of these levered long participants. And we saw huge amounts of liquidations in the last couple of days. I think the numbers were north of 700,000 accounts and several $billion worth of longs that were liquidated in 24 hours. So for me, on the cash and carry side, again, the big risk is if there's billions of dollars of liquidations happening from parties who are supposed to be on the opposite side of my trade, what does that ultimately mean for the stability of my trade itself?
Usually when you're doing a cash and carry trade, especially with a deterministic calendar end date, is that, it's basically a football and you're just waiting for the two to converge at the end. But you had higher returns from the crypto cash and carry trade. And is this part of it? Like normal cash and carry trade, you're not waking up in the morning thinking, oh shit, did I just lose all of my money? Did I get liquidated? Where this, you have a little bit of tentative nature looking at your screen in the morning.
I will even say that there's opportunity in these sort of disasters, assuming you don't realize that counterparty risk. If you look at sort of where Ethereum spot was trading versus the June contract, and I'll use FTX data, exchange data specifically, that was trading at about a 2% premium to spot, pretty consistently for the last couple of days. And then during the sell-off yesterday, jumped down to negative 6%. Again, all we were trying to get was that 2 to 0 convergence. If you had the system set up correctly, or you were watching the screens at the right time, and again, that can be hard for a sort of non-professional who's not trading 24/7 and perhaps isn't doing this in an automated fashion. But if you watched it drop past 0, well, that's all just extra return if you could close your position. So I think there's opportunity potentially in these types of market sell-offs to actually harvest a greater return from these cash and carry trades because of how broken the markets can get.
Does that mean Corey, Diamond Hands, cash and carry trade, Hofstein?
Well, I will tell you, the cash and carry trade just bumped along for me. It did a whole lot of nothing super exciting.
I am never going to financially recover from this.
So thinking about like wrapping this up, or how I'm thinking about today, is, as we started to allude to, dislocating markets breed opportunity. So is now the time to roll your positions? Like you said, you rolled some of them, but is that the way you're looking at the markets today? Is now I'm getting even fatter spreads, so this is the time I should really be going all in on this cash and carry trade?
Well, one of the things we've seen, interestingly, is that with all these liquidations, the demand for leverage has come down, and so a lot of the premiums have come in. So the attractiveness of the cash and carry trade has actually somewhat gone away. So there's this really interesting relationship between the more attractive the cash and carry trade is, arguably the more fragile the markets are, and the riskier the position potentially is, which should be the natural order of things. So right now, I think if you're putting these trades on in a very vanilla fashion, they're still interesting, but they're not nearly as interesting as they were 2 weeks ago.
Now make sure you like, subscribe, and hit that notification bell so you never miss one of these amazing episodes.